Greg Andrick here, bringing the Business Freedom Conversation Post. So, is the China economy collapsing? So, they've had the biggest real estate bubble ever just burst. It was a debt crisis. They couldn't fuel it with any more debt. They've reached kind of their maximum, and they're having this property bubble collapse. And people are thinking that this property bubble is starting a further slide because China has these demographic issues. There's a very large population imbalance between men and women because of the one-child rule that they recently got rid of. The trade war with us isn't helping any in their economy. We're moving a lot of our stuff to other places like India and Indonesia, and that's hurting the China economy. They've had to invest in low return infrastructure projects because they were growing so fast. And they're saying the China growth might be only 3%. Remember, they've had double-digit plus type of growth, but it's also now possible because of this property bubble bursting. Wait till you hear the number of units. They're projecting China's growth may be only 3%, but it also has a high likelihood of being negative, as is what's coming up. There are 65 million to 80 million empty apartments, and those apartments are valued at $10 trillion, and they're believing that those are going to decline in value by 20 to 25%. We're looking at a 2.5 to 3 trillion decline in wealth for Chinese consumers, and this is a country of savers. So they're expecting the Chinese consumer to react, which will further this problem where the property. Can you imagine having 65 million to 80 million empty apartments? The government borrowed money, did construction, people were working, but that's now come to an end because they've kind of maxed it out. And the Chinese consumer, because of this, is going to be under a lot of stress, and particularly in the luxury goods areas. Now, why is this important to us? Is because our economies have become so integrated over the last 40 years. If you do business with China, if Chinese people do business with you, you're going to have problems coming into the next year because everything is changing for them, and they're basically grinding to a halt due to this huge debt and these different things that they've done, which are artificial in nature. Good lesson for us. Hey, we have a government that borrows $2 trillion a year, 20% of our budget. That can't go on forever. China is the canary in the coal mine, saying borrowing money and building things to keep everybody going only goes so far. It has to be natural. It has to be the natural economy, which means government can't be in the center of everything, which is kind of what our current government's trying to do. So take a look at this video. It's from Yahoo Finance, and it's an expert on this that's speaking. I think you'll find it interesting, and take a look and figure out how it's going to affect your business. This is Greg Andrick, Business Freedom Conversation Post. I'll catch you on the next one.
Failed to hold on to most of their Monday gains as the latest effort to jumpstart the country's economy fell flat. Several U.S. sectors stand exposed to China's failure to relaunch. How hard will they be hit, and what will it take for the world's second largest economy to correct course? Joining me now with more, we've got Brian McCarthy, Chief Strategist and Managing Principal over at MacroLens. Great to have you here with us this morning, Brian. First and foremost, why has it struggled? What is this sputtering kind of derivative of, from your perspective?
Well, obviously, China is beset by a lot of geopolitical cross currents and risks on that front. They're in a transition of their economic model away from credit-fueled growth to something they hope to be more value-added, but is not going to involve any kind of market-based reform. And against that difficult backdrop, the biggest housing bubble we've probably ever seen has just blown up. So this is creating a massive drag on credit extension in the Chinese system. It's putting the system at great risk for debt deflation, and it's going to have grave ramifications for consumer confidence and the growth level in the Chinese economy.
And Brian, I think a lot of times when people look at the Chinese economy, they look back at that breakneck speed. China's in a very different sort of growth pattern right now, but we seem to be in this phase narrative-wise of either China's collapsing or China's taking over the world. What are some of the important nuances that investors should keep in mind when they look at China's growth and how it sort of trickles down to the U.S. economy?
Sure. So I'm sort of in the camp that China might be collapsing, actually. So, this property bubble, we're talking, potentially trillions of dollars in systemic losses. So we've gone from this situation where there were things like you alluded to. China's got demographic problems. China's been slowing consistently and steadily for a number of years. The investment-led growth model was basically they had to invest more and more money in lower return infrastructure projects. And then they're dealing with this sort of budding trade war over the last few years with the U.S. So there were all kinds of structural problems that were weighing on Chinese growth. And I think the question now in the wake of the property bubble is this going to continue to be a gradual controlled slowdown? And I think that's sort of the market consensus, that Chinese growth might slow to 3% or something like that over the next 3 or 4 years. And in that scenario, the direct risks to the U.S. are fairly limited. But there is another scenario in which that proves to be an optimistic case, and this bursting of the property bubble elicits a sharper, harder to control slowdown in the Chinese economy, where maybe their growth is negative next year, which I think is not an outrageous forecast. In that environment, you've probably got severe weakness on the RMB, which is then infecting other emerging market currencies. And as we saw in 2015, 2016, that kind of activity can generate financial market feedback on the West, which can have serious ramifications. So again, in the controlled slowdown, we're okay. But if it's worse than that, there will be volatility in U.S. markets.
Okay, and so just focusing in on what you were mentioning a moment ago, and perhaps what is the worst of the bear case scenario in a negative growth environment for China, where do you see that impacting some of the other U.S. companies even that have invested heavily into and have banked their own growth ambitions around success with the Chinese consumer and with the market more generally in China?
Yeah, I think we're going to find that a lot of Western multinationals have bad growth forecasts in terms of Chinese consumption. Chinese households are sitting on somewhere between 65 and 80 million empty apartments. That's about $10 trillion worth of real estate that's sitting there empty. And now we're seeing declines in Chinese real estate of, by some reports, 20 to 25%. This is going to get worse. So, you take a third of the value of the 10 trillion empty apartments, that's 3 trillion in wealth evaporating amongst Chinese consumers, particularly in the high wealth cohort. So pretty severe effects potentially for companies that sell luxury goods to Chinese consumers. But I think that the Chinese consumption story, again, just a lot of companies going to be stuck with bad forecasts there, because the Chinese consumer, I think, is going to remain under a lot of stress in the next few years.
And so, Brian, obviously very interconnected economies here. Which U.S. industries then would be the most exposed if there was suddenly a sharp negative downturn in China?
It's companies that do a lot of business in China. Like Starbucks has had good numbers because they have had a bit of a reopening boost to service sector activity in China. That has happened. It's just been swamped by other negative effects, mainly emanating from the property sector. But Nike, again, any consumer goods makers, luxury goods providers to China are just going to continue to see, I think, disappointing revenue numbers out of that market.
Especially when you have a nation of savers, any sort of economic downturn, everyone will sort of clutch the purse strings ever tighter. We do appreciate you joining us this morning, Brian McCarthy, Chief Strategist and Managing Principal at MacroLens. Thank you so much.
Thank you.